stop! Before you dump your life savings into that YieldMax ETF, promising 60% dividends, you need to see what Wall Street doesn't want you to know. I'm about to expose the hidden mechanics behind these sky-high yields that could either generate $5,000 monthly income or wipe out your retirement in one market crash. In this video, I'll show you exactly how YieldMax really works, reveal the 6 biggest risks they don't advertise, and break down the 3 most popular funds that investors are considering. What I discovered will shock you, and by the end, you'll know exactly whether YieldMax is your ticket to financial freedom or a sophisticated wealth trap. Here's what YieldMax wants you to believe. Park $100,000, collect $60,000 in dividends annually, and retire rich. Sounds incredible, right? But here's the brutal truth nobody talks about. While traditional blue-chip stocks like Johnson & Johnson pay around 3% annually, YieldMax funds are currently yielding 50 to 60%, returns that seem almost too good to be true. And as we all know, when something seems too good to be true in finance, it usually is. But here's the critical detail they bury in fine print. Over 94% of these massive dividends are actually your own money being returned to you, not real income from investments. It's like withdrawing from your own savings account and calling it profit. But before you click away thinking this is just another hit piece, hold on. I've spent weeks analyzing their strategies and running real numbers. What I found isn't black and white. It's a complex financial instrument that could work for specific investors under specific conditions, but could be disastrous for others. In this video, I'll show you exactly when YieldMax makes sense, and more importantly, when it doesn't. Let me cut through the marketing fluff and explain exactly what you're buying. YieldMax isn't your grandfather's dividend stock. Think of them as a financial casino that's figured out how to consistently win small bets while occasionally losing big. Here's the simple version. YieldMax launched in 2022, creating over 30 different ETFs that use something called covered call strategy to generate those eye-popping yields. Instead of betting on market direction like most traders, they're essentially selling insurance on stock movements. When markets stay calm, they collect premiums like clockwork. That's your dividend. But when volatility strikes, that's when the math becomes brutal. The key difference you need to understand: when Apple pays you a 3% dividend, Apple's stock typically grows over time. When YieldMax pays you that 60% dividend, the fund's price often decreases to compensate. It's like selling pieces of your house to pay monthly expenses. Eventually, you run out of house. But here's where it gets tricky. In certain market conditions, this strategy can actually outperform traditional investments, and I'll show you exactly when that happens later in this video. Let me reveal the 6 biggest risks that YieldMax marketing conveniently ignores. First, there's the volatility trap. During the August 2024 market correction, while the S&P 500 recovered quickly, YieldMax funds experienced amplified downside with limited recovery potential. You get hurt more in down markets than you benefit in up markets. Second, and this is the bombshell, there's the return of capital illusion. Recent YieldMax distributions contain 94.96% return of capital and only 5.04% actual income. This means when you get that $6,000 dividend on your $10,000 investment, $5,700 is just your own money being handed back to you. You're not earning income. You're liquidating your investment. Third is the tax bomb. Those massive dividends are taxed as ordinary income, not qualified dividends. For high earners, that 60% yield becomes 37% after taxes. Fourth, there's the fee massacre. YieldMax charges 0.99% to 1.28% annually. That's 5 to 40 times more than traditional index funds. When your fund's price is declining while you pay premium fees, you're fighting mathematics itself. Fifth is the growth ceiling. When Tesla skyrockets 200% in a year, YieldMax Tesla holders miss most of that upside because they've sold their call options. You're essentially betting against your own holdings. Finally, there's the compound killer. For young investors, the opportunity cost is massive. Missing compound growth over decades far outweighs current income benefits. Let me show you exactly what happens when you invest $100,000 in YieldMax versus traditional strategies. In the YieldMax scenario, you get $60,000 in dividends during year one, but the fund price drops 25%, giving you a total of $135,000, which is $75,000 in remaining principal, plus $60,000 in dividends. After taxes, assuming a 37% tax rate on ordinary income, you're left with $122,200. Compare this to the traditional S&P 500 scenario, where you receive $2,000 in dividend, and the fund grows 10%, giving you a total of $112,000, which becomes $111,200 after taxes, using qualified dividend rates. The YieldMax advantage disappears quickly when you factor in taxes, price erosion, and the fact that most of your income is just your own money coming back to you. Now let me break down the 3 most popular YieldMax funds that investors are considering. Let's start with SPYI, the S&P 500 Income ETF, which currently yields about 40%. SPYI writes covered calls on the entire S&P 500 index, giving you exposure to America's 500 largest companies while generating income through options premiums. Your $10,000 investment generates approximately $4,000 in annual distributions, while maintaining broad market exposure, making this the most diversified YieldMax option available. The upside is that you're not betting on any single company's performance, but the downside is significant. You cap your upside during major market rallies. In 2023, when the S&P 500 gained 24%, SPYI holders missed most of those gains because they'd sold their call options. The expense ratio sits at 0.99%, meaning you pay $99 annually for every $10,000 invested. And SPYI's performance closely mirrors overall market volatility, with amplified downside during turbulent periods. Next is Apply, the Apple Income ETF, yielding approximately 45%. Apply focuses exclusively on Apple stock, using covered call strategies to generate income from one of the world's most stable tech companies. Your $10,000 investment produces approximately $4,500 in annual distribution, and Apple's massive cash reserves, consistent performance, and established business model provide more predictability than growth stocks. Apple tends to be less volatile than other tech giants, potentially making price erosion more manageable. However, you're concentrating everything on a single company, which means if Apple faces regulatory challenges, supply chain issues, or competitive threats, a PLI gets hit hard. The covered call strategy means you miss out if Apple announces breakthrough products or services that drive massive stock price appreciation, and recent Apply distributions have contained significant return of capital components, meaning much of your income is actually your investment being returned to you. Finally, there's YieldMax, the YieldMax Universe ETF, which yields about 60% and represents the most complex option. YieldMax is a fund of funds that holds all other YieldMax ETFs, providing instant diversification across their entire strategy spectrum. It's like buying every slot machine in the casino instead of just one. Your $10,000 generates approximately $6,000 in annual distributions while spreading risk across multiple underlying strategies, giving you exposure to tech stocks, traditional large caps, and various sector plays all in one fund. However, you're paying double fees since YieldMax charges a 1.28% expense ratio, plus you indirectly pay the fees of all underlying funds. This diversification doesn't protect you from the fundamental flaws of covered call strategies during major market moves. And when markets surge, all YieldMax funds underperform, so diversifying among them doesn't help. Most importantly, YieldMax's recent distributions show 94.96% return of capital and only 5.04% actual income, which means nearly all of your 60% yield is just your own investment being liquidated and handed back to you. It's sophisticated financial engineering, not wealth creation. So now, who should consider YieldMax? Despite the risks, YieldMax isn't universally bad. There are 3 investor types where this strategy might make sense. The first is the wealthy retiree, who has a $2 million portfolio, allocates only $200,000 to YieldMax for immediate income, and keeps the bulk in growth investments. These investors can handle the volatility and aren't dependent on principal growth. The second type is the tax-advantaged maximizer who's maxing out IRA contributions and wants aggressive income generation inside tax-protected accounts where the tax bomb doesn't apply. The third is the short-term income seeker who needs immediate cash flow for 2 to 3 years and understands they're trading long-term growth for current income. If you don't fit these profiles, traditional dividend stocks will likely serve you better. If you're still considering YieldMax after everything I've revealed, here's what experienced investors are doing. They follow what I call the 5-10-15 rule. Maximum 5% of your total portfolio. Only invest money you won't need for 10 years or more, and expect 15% annual volatility in fund prices. They also use the tax-smart approach by only investing through IRAs or 401ks, never holding in taxable accounts, and reinvesting dividends automatically. Finally, they have an exit strategy that includes setting a stop loss at 20% principal decline, taking profits if fund prices recover to break even, and rebalancing quarterly rather than monthly. If you found this analysis helpful, hit that like button and subscribe for more no BS investment breakdowns. I'll see you in the next video.